Greetings, everybody. Happy Cinco de Mayo to all my friends and family and everybody out there in the interwebs. Not having tacos today. Unfortunately, I'm going to cook spaghetti tonight. I had tacos a couple days ago. So anyways, like I said, I hope everybody's having a fantastic Cinco de Mayo. It is well, it's not really a holiday, but it's an excuse for people to drink beer and eat tacos and have a good time, which, hey, there's nothing wrong with that. So I don't drink alcohol anymore. So, but I mean, on occasion I might have a IPA here or there, but pretty much cut that out of my life. And because with my arthritis, it makes my inflammation feel like dog shit. So, anyways, speaking of dog crap, the market looked awful today. It was, I mean, as much as I said yesterday, don't take one day as a as the be all end all. We went right back to the course we've been on for a while now, and had another terrible day in the market. So anyways, let's go ahead and look at those exchanges and see how things finished out for the day. The Dow Jones was down 3.94%, closed at 32,717. S&P 500 was down 4.44%, closed at 4109. NASDAQ, down 5.96% today, closed at 12,191. Small caps were down over 5%. The VIX was up 29.39% today. It's back up over 30, closed at 3289. Looking at the other exchanges here in the Americas, Canada was down 2.86, Brazil down 3.45, Mexico down 1.44. Moving over to the Asian markets, Germany was down 0.49, the UK up 0.13, France was down 0.43, the Euro Stoxx was down 0.76, Netherlands was down 0.36, Spain down 0.77, Italy down 0.6, Switzerland was flat, up 0.04, Portugal down 0.72, and Belgium up 0.78. Moving over towards Eastern Europe, Austria was down 3.25, Sweden down 1.29, Denmark down 0.55. The Russian exchanges, the MOEX was up 1.33, the RTSI up 0.52. The Polish market down 2.58, Hungary down 1.52. Heading a little further east, Turkey was up 1.47, Israel down 0.27, Saudi Arabia was up 0.66, Japan, moving over into the Asian markets, Japan was down 0.11. The rest of the Asian markets look pretty good. Australia was up 0.82, New Zealand up 0.99, Shanghai up 0.68, the SZSE component out of China was up 0.23. The China A50 down 0.39. The DJ Shanghai up 0.53. The Hang Seng down 0.36. And the Taiwan weighted up 0.79. And then a couple of these smaller ones, it looks kind of mixed. So, starting out the day last night over in Asia, things look pretty good. Had a few down exchanges, but for the most part, it was up. And then you get over to Europe, it was mostly down. And then you get to the Americas, and it was a bloodbath here in the United States. So again, I don't think we're going to find a way to, in one of the last articles I'm going to review, I don't think we're going to have the soft landing that everyone at the Fed and at the Treasury and everyone in Washington hopes to accomplish. I think, and I got a video to accompany that. So I did get a copyrighted strike yesterday for playing the Star Wars music during my video. I guess I didn't get permission from John, whatever his name is. Oh, well, I can live with that. All right, let's take a look at the read through today's market commentary. Dow sheds 1,000 points as U.S. bond yields spike, triggers tech fire sale. It's written by Yassine Ibrahim from Investing. The Dow slumped Thursday following a rout in technology stocks as Treasury yields climbed to multi-year highs a day after the Federal Reserve delivered its biggest interest rate hike in more than 2 decades. Well, it wasn't enough. Big tech was led lower by more than 5% slump in Amazon and Facebook, with Alphabet, Apple, and Microsoft not far behind, as rising treasury yields, the enemy of growth stocks like tech, jumped. The 10-year treasury yield briefly jumped to 3.1%, its highest level since November of 2018, a day after the Fed delivered a 50 basis point increase. Quote, "There's been some hope that the 10-year treasury yield approach 3% things might stabilize," said chief strategist at Spouting Rock Asset Management, Reese Williams, told investing.com in an interview today. Quote, "Over the last 15 years since the great financial crisis, economies have slowed once the rate on the 10-year treasury crossed 3%. I think it's a bit disconcerting that rates haven't slowed, and that's why the markets are reacting poorly to that," Williams added. "The clear breakout above 3% will likely lead to further climb in rates, likely putting growth stocks in the crosshairs for a while longer." Quote, "The next objective for the 10-year treasury yield would be about 3.25%. I think it's the next reasonable point where you could see yields reset a little bit and see things sort of normalize," Chief Market Strategist David Keller at stockcharts.com told investing.com in an interview earlier this week. Fed Chairman Jerome Powell on Wednesday downplayed the prospect of a larger 75 basis point rate hike, but said further 50 basis point rate hikes were in consideration in the coming months, keeping investor bets on the year-end Fed funds rate intact. Quote, "We now see a third 50 basis point rate hike as likely at the July FOMC and 25 basis points for the balance of the year, bringing the Fed's funds rate at the end of 2022 to 2.625%, Morgan Stanley said in a note. Yeah, I don't know if I would use the previous financial calamity that we had, a decade and a half ago as a real good point of reference, because we kept interest rates at or near zero for the better part of a decade and a half. And I would argue that all the inflation we're feeling, or a good majority of, I don't want to say all, a large majority of the inflation we're feeling right now is due to the fact that we had so many years of zero, basically free lending, in this economy. We've created such a huge bubble that, when it does pop, where is everything going to reprice at? Where equity is going to be? Where's the fixed income market going to look like? What are commodities going to look like? Are they going to continue to rally, or are they going to stabilize or even fall? So, it's hard to just get mad at one person or one entity, but you have to imagine that the people at the Fed, which I did kind of an in-depth talk about them on Monday, about how all these people that work at the Federal Reserve have only worked at the Federal Reserve their entire lives, or in the Federal Reserve system, and they have, it seems like, no clue of what really causes bubbles in economies, and what the effect of printing 40% of the money, or adding 40% to the money supply, in a 2-year period. I mean, I have to assume that these are educated people, but it makes me wonder. All right, next article here. U.S. weekly jobless claims rise, productivity plunges at fastest pace in 74 years. Written by Lucia Mutakani at Reuters. New claims for U.S. unemployment benefits increased to a more than 2-month high last week, but remained at a level consistent with tightening labor market conditions and further wage gains that could keep inflation hot for a while. The report from the Labor Department on Thursday also showed the number of Americans collecting state unemployment checks was the smallest in more than 52 years. Towards the end of April, economists brushed off last week's increase in initial claims, arguing that the data are volatile around moving holidays like Easter, Passover, and school spring breaks. Hang on a second, I gotta clear my throat. Sorry about that. It's always when you have to do a long talk that you get the frogs in your throat. So anyways, quote, "The latest level of initial claim filings is still pretty low by broad historical standards, and continuing claims filings keep trending lower through today's report. So overall, we believe the labor market remains strong," said Daniel Silver, an economist at JP Morgan in New York. Initial claims for state benefits rose 19,000 to a seasonally adjusted 200,000 for the week that ended April 30th, the highest since mid-February. Economists polled by Reuters had forecast 182,000 applications for the latest week. Claims at 200,000 are viewed as consistent with strong demand for workers. They have declined from a record high of 6.137 million in early April of 2020. The number of people receiving benefits after an initial week of aid dropped 19,000 to 1.384 million during the week that ended April 23rd. That was the lowest level for the so-called continuing claims since January of 1970. Government data this week showed there were a record 11.5 million job openings on the last day of March, which widened the job workers gap to a record 3.4% of the labor force from 3.1% in February. The labor market imbalance is forcing employers to increase wages, contributing to soaring inflation. Compensation for American workers logged its largest increase in more than 3 decades in the first quarter. The Federal Reserve on Wednesday raised its policy interest rate by 0.5 percentage point, the biggest in 22 years, and said the U.S. Central Bank would begin trimming its bond holdings next month as it battles sky-high inflation. It started raising rates in March. It started raising rates in March. Fed Chair Jerome Powell told reporters that, quote, the labor market is extremely tight and inflation is much too high, end quote. The rise in claims last week was driven by a 7,342 jump in filings in New York and 3,169 increase in Illinois. Those gains offset notable declines in California, Connecticut, Massachusetts, New Jersey, and Ohio. The government is expected to report on Friday that non-farm payrolls increased by 391,000 jobs in April after rising 431,000 in March, according to a Reuters survey of economists. Job growth has exceeded 400,000 for 11 straight months, but there are signs that high labor costs are starting to hurt small businesses, especially those in the leisure and hospitality industry. A separate report from global outplacement firm Challenger Gray and Christmas on Thursday showed job cuts announced by U.S.-based companies rose 14% to 24,286 in April. The second straight monthly increase in layoffs was led by the leisure and hospitality industry. The rise in layoffs was in sync with the ADP National Employment Report on Wednesday, which showed the smallest private payroll gains in 2 years in April as employment at businesses with less than 50 workers fell. Rising labor costs were reinforced by a third report from the Labor Department showing worker productivity plummeting at its sharpest pace in more than 74 years in the first quarter, suggesting that the Fed cannot, for now, rely on workers being more productive to rein in inflation. Non-farm productivity, which measures hourly output per worker, plunged at 7.5% annualized rate last quarter, the deepest slide since the third quarter of 1947. That followed a 6.3% growth pace in the fourth quarter. But last quarter's plunge likely exaggerates the pace of decline in productivity, which was flagged in last week's first quarter GDP report. The economy contracted at a 1.4% rate in the January through March period. Productivity fell at only 0.6% pace from a year ago. It has been volatile since the start of the COVID-19 pandemic more than 2 years ago. Hours worked increased at a 5.5% rate in the first quarter. Unit labor costs, the price of labor per single unit of output, shot up at an 11.6% rate. That followed a 1% growth pace in the October through December quarter. Unit labor costs increased at a 7.2% rate from a year ago. Quote, there is no getting around the fact that the tight state of the labor market has pushed, quote, real labor costs for employers well above levels consistent with the Fed's 2% inflation goal, said Sarah House, a senior economist at Wells Fargo in Charlotte, North Carolina. Quote, labor costs are homegrown and signal that the Fed still has significant work to do in bringing down inflation. Yeah, it's a mess out there, folks. I mean, yes, the job market is decent. I don't know if I'd say great. I know that the folks at the Fed like to use the word tight, but it doesn't seem like things are all that great, especially when everything keeps getting more expensive. So anyways, all right, next article here. U.S. rate futures price in a 75% chance of a 75 basis point hike in June. It's written by Gertrude Chavez-Dreyfus from Reuters. Futures on the federal funds rate priced in on Thursday a roughly 75% chance of a 0.75 of a percentage point tightening by the Federal Reserve at the next month's policy meeting, a day after Fed Chair Jerome Powell ruled out such a hike. Yeah, They never backtrack. Quote, a 75 basis point increase is not something that the committee is actively considering, Powell said on Wednesday in a response to a question at a press conference following the Fed's latest meeting, where it also signaled more rate increases. Rate futures have also factored in more than 200 basis points of cumulative hikes for 2022 and a year-end Fed funds rate of 2.85%. Quote, there's a lot of reflection and repositioning going on after the FOMC decision and whether the expected rate hikes were dovish or hawkish, said Kim Rupert, managing director, fixed income at Action Economics in San Francisco. Quote, and though Powell dismissed notions of a 75 basis point hike, the FOMC is still on the march and looks to boost the Fed funds rate up to 2.625% to year end. The Fed is still focused on tackling inflation while growth is still decent this year, and this just gives the Fed the opportunity to continue to keep raising rates, end quote. The CME FedWatch tool also showed a larger probability of a 75 basis point increase at 83%. So, I mean, that would actually be a good thing. I would have liked to have seen them raise rates maybe a full 100 basis points at each of these last two meetings. Now we'd be sitting at about 2% right now. Maybe another 75 basis points or 100 basis points at the next two meetings, get us up to 3-4%, see how fast, what sort of a dent that puts in the inflation, and, play it by ear, see if you need to go further. But, these little nibbles, it's like taking a teeny bite of a cracker and like, oh, I'm so full. It's like, it's not going to work. And I don't know how many other folks out there are falling for this BS. All right. One last article here. Why the Fed rally failed. The Dow Jones has a catch 2022 problem. A little play on that book. Wednesday's bullish news conference from Federal Reserve Chief Jerome Powell sparked the biggest gain for the Dow Jones and S&P 500 since 2020, while the Nasdaq Composite climbed out of bear market territory for a day. A day later, all those Dow and S&P gains have been erased, and a bear is once again stalking the Nasdaq. The simplest explanation for the stock market overnight U-turn is that the Dow Jones has what might be described as a catch 2022 problem, like the predicament facing the protagonist in Joseph Heller's famed 1961 satirical novel Catch 22. The only way to solve the problem also ensures there can be no resolution. The Dow's predicament is that the Federal Reserve has to tighten policy so far and so fast that it risks triggering inflation. That the way out of this less hawkish Fed and Powell, the way out is a less hawkish Fed, and Powell seemed to deliver that on Wednesday, fueling a rally. All it took was for Powell to take the possibility of a 75 basis point hike off the table, at least for the June meeting. If a somewhat less hawkish Fed can still adequately tame inflation, the Dow is set to rally. Yet, as Powell has explained recently, monetary policy, quote, reaches the real economy, end quote, by changing financial conditions such as market-based interest rates and stock prices. In other words, seriously tightening policy and doing it expeditiously, as Powell said, is needed, almost implicitly requires lower stock prices. Just how low is far from clear, but Wednesday's 1,000-point Dow Jones rally probably wasn't what the Fed was looking for. Just a hint of a dovish Fed helped send the 10-year Treasury yield to a new cycle high of 3.1% on Thursday. Meanwhile, the Dow Jones Industrial Average tumbled 1,120 points or 3.3% in aftermarket action. The S&P 500 fell 3.8% and the Nasdaq lost 5.2%. The Dow's Catch 2022 problem, though, isn't as entrenched as Captain Yossarian's Catch-22. Eventually, inflation pressures may subside enough for the Fed to relax its hawkish talons, but for a good part of 2022, the Dow path higher may create its own downdraft. The Fed may have its own Catch-2022 problem as well. The reason why the Fed policy may not produce a recession is also the reason why it may not be able to avoid a hard landing. More to come. A Deutsche Bank strategist, Jim Reed, wrote in his Thursday morning commentary, Powell sought to provide assurance that the Fed can achieve a soft landing because business and household finances are strong enough to withstand a significant tightening in monetary policy. Yet, quote, that very strength when inflation is at multi-decade highs is why policy will probably need to reach restrictive levels, not currently appreciated by market pricing, end quote, Reed wrote. First test of Powell's soft landing outlook comes with Friday's jobs report on Wednesday. Powell said that he thinks unemployment rate is close to a bottom because the labor force participation is on the rise and job creation will slow. Any further decline in unemployment rate will be, quote, relatively limited, he said. Yeah, we'll see. Here's what let me put this video on. This is what I really see happening here. There we go. Here's an F-18 coming in. Yeah, that's the soft landing that Powell's working on. Where's the next one? Helo crash. This one should be fun. Speed it up a little. Some of these are kind of slow. Oh, there he goes. Over the side. Oh, no, that's the next one. Another helo crash. Uh-oh. This one goes into the drink. Uh-oh. Not good. Ah! So these are my examples of what the market's going to do over the next few months, maybe a year. Here comes this trainer coming in. Doesn't look good. Oh, no. Oh, no. Oh, no. You're going to miss the landing area. Oh! He probably died. And here's one with a happy ending. Here he comes. The Fed might need a net to drop your nose.
Stay with it. Stay with it. Stay with it.
See? That one didn't go in the drink.
Beautiful.
Doesn't look like anyone died either. All right. Well, anyways, and crazy, I used to work in that environment. Just imagine, it's nuts that I didn't get myself killed. I didn't spend a lot of time out on the ship, but the flight line wasn't much safer. Anyways, all right. Well, that's everything I had for today. So, as far as everything going on in the world, we're going to go through a little pain. I don't know how I can, try to, let people know, that what we're going to go through over the next year or two is not going to be very pleasant. It's going to be much like what we went through back in 08, 09, where unfortunately the economy and the markets are going to have to bottom out to get rates under control, let the market, recalibrate, flush out all the bad investment that's been in the economy for the last 15 years because rates have been just so cheap. And, yeah, could the dollar crash? Yes. Could the stock market completely capitulate and fall to nothing? Yes. Could our feckless leaders in Washington run the country into the ground and we have to start over? That's very solid. I look at everything, like I said, before, I look at everything from the laws of probability. What, like right now, do we have a greater than 50% chance that the stock market's going to recede? I'd say yes. Just based on everything else that's going on around us. When we get closer to the, when things bottom out, then you can evaluate, hey, do I want to put my money back to work or do I want to leave it back, continue to leave it on the sidelines? Only you can, only people can really make that choice. But, the way I look at it is, if the market drops, another 50% or drops 50% from its peak and the Dow is, 16,000, you make a calculated risk. Hey, do I want to put more of my assets back into the equity markets at that point? And if it does go down another 5 or 10%, big deal. I might lose 5% off my reinvestment at this point, but it's a lot better than losing 50% from the very top. So hopefully, the folks that if you're not working with me and you're working with somebody else, hopefully they've built a moat around your portfolio. So hopefully things are, it's not too damaging right now. But if not, hey, I know a guy, this guy right here. So feel free to reach out to me if you need some help or you're just worried about what's going on and you need somebody to talk to. Go to dsafinancialgroup.com. All my contact information's there, phone number, email. You want to book a meeting, you can take care of it right then. So I'm always here for people if they need help. I'm never going to turn anyone away who, is serious and wants to get their finances back on track. But anyways, all right. Well, hope everyone has a fantastic evening. I'll be back tomorrow with the weekly wrap up and any other interesting news. So hopefully we have a little bit better day tomorrow, but I wouldn't count on it. It's going to be volatile for a while. So just buckle up, Buttercup, and have a great evening. Talk to you then. Bye-bye.